Real quickly, my name is Paul Zarling. I'm the managing partner here at Client First. So thank you for coming to our noon lunch and learn, talking markets on the third quarter. We have a great team to talk with you. It's going to be David, Ian, and also Kevin. But before we begin, a couple housekeeping items. You should have the printout in front of you. You should have a pen, also a feedback form. We also have a QR code right there. Food's available in the back. Nice Italian lunch from Brian and his team. How about a round of applause for Brian? Bathrooms are at the rear of the hall. And then if you could please silence your smartphones out of courtesy for other guests, that would be helpful. And for those that have attended these regularly, you know we like to start these off with a little bit of trivia, right? So the trivia question is, when was the first bond created? And I'm not talking about Ian Fleming and his friend James. When was the first bond created? How about some guesses? Right here's scuttlebutt. And so we'll say 1860s, right? Okay, Civil War.
1790.
1790. Okay, she's probably thinking a little bit after the Revolutionary War.
Could you narrow the question? Are we talking USA?
The question is, when was the first bond created? The request is, can I narrow the question? And the answer is no. I will not narrow the question. So we'll probably give you global in scope by my answer. And the inference you can make from that.
I'd say about 1718 Liberty bonds.
1718 Liberty bonds. Okay. Was there a guest from the table? She's thinking. Oh, we have one behind. Go ahead.
1789.
1789? Okay. All right, so the very, very, very first bond that is recorded in history is 2400 BC. So you guys are just a little off. That was in Mesopotamia, or present-day Iraq, and it was a guarantee on grain when corn was the currency. Let's fast forward a little bit to modern times. We'll say modern times, and we'll say, post 1500, or we'll go to AD. So the Bank of England created one in 1693. To what a lot of you guys are thinking of, there's a war in the air, so how do you pay for a war? They had to pay for a war with France, right? The U.S. created one in very close to the Revolutionary times, so late 1780s, to do that, and then they released a couple more after that with Alexander Hamilton. And then the Liberty bonds, who brought the Liberty bond?
That lady did.
Right here. That was actually done in 19 teens in the U.S. That was for World War I. Right, so that's what that was for.
1917.
Yep.
Was World War I.
Yep. So a lot of you, some of these bonds are to pay for, unfortunately, warfare with everything. But we're going to talk about bonds today. We're also going to introduce the speakers. So David is going to be leading us off. He has been navigating the markets for almost 15 years, father of four. Also going to see Ian, who's with us from Charlotte. I think his kid may have the curliest hair ever, just a cutie. And then Kevin Firari is also going to be joining us. Recently married a new homeowner, so you'll see some of that. So without further ado, a round of applause for our presenters.
So, like any good student in a teacher's class, you probably questioned the things in the questions you took. I'm going to question Paul on the first bond ever created with a corny answer, but a very true answer, which is the covenantal bond since the beginning of time between God and His creation. Yeah. That's the true bond. So, we're going to talk a lot today. I'm really excited about this. You know, it's not often I only get to do this once a quarter. So I jump out of my shoes when I get up here because we get to talk markets with a place that's packed. It's always for educational, informational purposes only. You can't take it as investment advice. Some of you are clients, some of you are not. We don't know your personal situation. So the information in this presentation can't be taken that way. Today, we're going to talk about a lot of different things. We're going to talk about focusing on the signal and avoiding the noise. The current market environment. Ian's going to talk about key market levels what it means to hit a sell button. He's also going to talk about topic du jour, because we're all waiting for the ads to end, the midterm election, and seasonality. Kevin's going to come up and he's going to talk about problems with the 60-40 portfolio, as well as what is the S&P 500, how is it made, and why is that important. Then we're going to get all of us up here, and Paul's going to ask us some questions, including we're going to kind of discuss the 3 questions that you guys answered at the beginning. So it's going to be pretty awesome. Then we'll have a game plan for how we're handling this current market environment. So if you're new with us, that's a different approach than other places. A lot of places will buy and hold regardless of what is happening. Our approach is let's have a game plan for what's unfolding in the market. Then we'll take care of some housekeeping and let you guys out of here. I always like to start with a couple updates from my family, let you know I'm a real person, not just a robot that walks around. Still madly in love with my wife. Eli got elected homecoming king. Ava continues to rehab her ACL. She's up to running and doing some cutting and playing with a soccer ball, which is really exciting for only 3 months after her ACL surgery. God makes the human body amazing. These are some of my guys that are graduating this year or close to graduating, depending on who it is in the picture that I coach soccer 4 years with. Lydia just had a birthday, and Micah is doing many fun 6th grade things, including great humor. It's a pleasure because he asks really great questions. So, what we're talking about today is the market, but it's also how we view the market using our adaptive investment management process, which fits into our overall true holistic plan. So we're not just an asset management firm. We're really truly trying to solve for everyday Americans a complete picture with their financial plan. So that can include Social Security planning, estate planning, taxes. We have an entire tax team. Insurance, an entire insurance team. All these things come to bear for our clients. So in the industry, there's something called family office. And what that is a team of experts that's around billionaire families. So they have their own CPA, their own CFP, their own attorney. That's what we're building for everyday people like you and me. So what we're talking about today is this piece of the puzzle, investments and managing risk, which is our number one priority. And why do we want to focus on the signal and avoid the noise? And quite simply, it's because the signal is price and price is truth. We live in a world where everybody lives, or people try to live in their own truth. I'll give you an example. Coca-Cola. I'm having some right now because I have a slight headache. I'm trying to push that off. So I'm having some caffeine. When I was in college, I used to have some rum with it. So, but do you know what I thought they were called? Roman Cokes. When in Rome, this is what you have.
Yeah, right.
Until one day the bartender's pouring it in, and I see rum on the bottle. Oh, it's rum and Coke. It's not a Roman Coke. So I was living in my own truth because I didn't have the true information. I had created something that no one checked me on until I saw it on the bottle. So, truth matters. And we know that we have a hard time with what the financial media provides us. You'll recall back in October, 1 year ago, we were giving the Fed and financial media a really hard time about using the term transitory, and as it pertains to inflation. And it turns out they were wrong. It is here. Like this headline here, we see transitory inflation lasting quite a while. That's like saying we expect to see this be temporary for a long time. So, inflation. Couldn't trust him on that. Next one's going to be a little controversial. Don't read into it too much. All I'm highlighting is that we had the President of the United States, the CDC director, the NIAID director say if you get the vaccine, COVID will not be transmissible. And those who said, we don't think so, immediately got shamed and bashed and censored. And here we have the CDC saying, hey, if you get the vaccine, still wear a mask, still separate, because you can transmit you can transmit COVID. All the while, the whole time, online, you can track this in real time, they changed the definition of vaccine. That's the Roman Coke world. Recession. The headlines lately are, well, we could avoid a light recession. We could avoid it. Ladies and gentlemen, the definition by many economists is 2 periods of declining GDP. We have that. We have a recession. We don't get to make up our own truths. We don't get to live in the Roman Coke world. It's rum and Coke. It's truth. It's price. These are the things that we're going to manage assets by. We're not going to use news. We're not going to use the topic du jour because those things don't work. Because if you had listened to the Fed, a little bit problematic. What are the 3 main objectives of our process? For our clients, when a new position goes in their account, the 3 main objectives are it's either a big win, or small loss. We are not going to be perfect in our selection, but we're in the business of mitigating as much risk as we can when a position moves against us. So, why do we do this? Because there's a math problem with buy and hold investing in corrections. Some of you are familiar with, for example, 0809, right? That was a 56% correction, which would have taken a 122% return to get back to even. It did it. It did it in twice as long a time as the correction took to take place, which can be okay when you're in your 20s and 30s, but when you're in retirement, that can be kind of hard when you're taking withdrawals and your account's cut in half. It's a double compounding that takes place. Dot-com bubble, minus 46%, took twice as long to get back to even, took 85% to get back to even. This is the COVID crash, minus 35% in 26 trading days, fastest correction on record from a high to a low. I provided also the adaptive different models and their returns during that correction. Our clients pay us to mute. We're never going to eliminate volatility or completely keep an account balance even, but you pay us to reduce these events so that we're not participating to the full side all the way down on these market events. And what's interesting to know, the reason why I threw this slide on here is on average, the market experiences a 20+% correction every 4.5 years. We've had 3 since 2018. So in the last 4 years, we've had 3, which is a most challenging time for the system, but also an appropriate time to help level out those drawdowns in case you're taking withdrawals out. Here's another, and this isn't actually showing that well on here. So we're actually going to have to ignore this slide. It looks like some numbers got switched around. And I don't know if it does it look like that on your hard copy with the numbers not lining up. We'll have to address that for this evening. This column here is the performance of these models in the 2018 correction. This column here is the adaptive performance returns during this correction. This column here are the adaptive returns during the current correction. So hopefully maybe you can draw some arrows and get yourself there. I apologize for that. Triple check this, so I'm not sure why it showed up like that. But the main point being, our business is we can't eliminate 100% drawdown, but we can help reduce and cushion it. so that we don't have such hard work to get back to even. Now, what I was using up there was the S&P 500, and Kevin's going to talk about it in a little bit, and that's the best shirt in the closet. Okay, when we actually do our research and look at what's been going on in this market, so when we look at year-to-date or the past 52 weeks, so in this section here, we're looking 2022 year-to-date. Here we're looking back to October of 2021. We can see that, for example, in the NASDAQ, down 32% year-to-date. The average stock inside of it, however, down 48. NASDAQ, and that's the NASDAQ composite. NASDAQ 100, down 36%. Average member, 52 weeks, minus 40. You can line up over here and see what that would take to get back to even. It's kind of a big deal. Big correction for a while now. In fact, such a big correction that it has some stellar company with 2018 and 2008. And what I mean by that is what this chart is saying is in green is the percentage of assets or vehicles that have a positive return year to date. So, see how the green bar is really tiny? That means there's not a lot of things that are positive. In fact, I would wager that this green box is energy stocks. We'll get into that in a little bit. This red bar means how many things are in a negative return. Almost everything. It's been a decent correction. This chart here shows through the beginning of October the average retail experience. And the reason why I like to do this is because if you're a client with us and you have 100% of your funds with us, sometimes it can be hard to see what's happening on the outside as far as what's going on with other accounts that if it wasn't at Client First or wasn't being managed with Adaptiv. And here we have a drawdown of about 37% for the average retail account. Obviously, some are going to be higher, some are going to be worse. We've seen prospects come in with minus 50. It's a thing. And then you're in purgatory because they don't want to sell. Right? That's a mental game. You're down 50. How could I possibly sell at this point? There's a minus 50 never keeps it from going to minus 80. I'm not calling for that. I'm just saying. There's a reason why we have the sell button. During this period of time, I do have the adaptive performance numbers up there. The most aggressive model we run is the ultra growth. Then there's growth, moderate, and balanced. So what are we really doing? We're trying to get rid of these major market events out of your life as a retiree. That's really what's going on. We're never going to capture just a ton of upside, but I can tell you we're going to do a good job of muting the downside. And we've proven that through the previous slides. So with that, I'm going to have Ian McMillan come up, who some of you may have been seeing. He goes on a couple times a month with Charles Payne on Fox Business. He does a great job. So he's going to come up and talk about a couple important things worth paying attention to. Please, round of applause for Ian.
Thank you. I will do the same as David. So one thing that's different, I actually am a robot. And this is my robot family. I kid. Yes, Paul mentioned my 3-year-old, Connor. He does have quite curly hair. It is pretty rare for us to go out in public and not get stopped at least once with someone wanting to comment on his hair. But yes, we've had a fun summer and fall together, did the pumpkin patch last weekend. Here's my wife and I and my bear market beard in Portland last month. Enjoying some football out on the patio. That's something that our family is very, very into. We spend a lot of time outside, so great time of year for that. So we are going to talk about key market levels on the main indices here in the U.S. and then some things abroad. And we'll look at treasuries as well. I'm sure you guys can already guess what the treasury chart looks like. So S&P 500, and where most of these charts are just going to go, we're going to start with basically the COVID highs to kind of give some context about where we are here. So on S&P, obviously it's gotten a lot of attention, as Dave said. Kevin will go into that later in more detail. One thing I wanted to point out, obviously the last few days in the market have been pretty big. I'm sure you guys have seen that on your news or market channel of choice. Here's what a 6% rally looks like in the context of what's been going on over, obviously through 2022, but really starting back here in Q4 2021. So not really a big difference maker. I would say that this is clearly a downtrend. Few rallies here and there, but overall, not really something we need to be aggressively involved in, especially if we're going to continue to hover around these June lows around 36.50. The NASDAQ 100, not too much different, also sitting down by its June lows. These are levels where if we cannot recover and hold, then mathematically speaking, it's impossible for stock markets to go higher. If you can't recapture 11,200, how would you ever get to 12,800? That's just the way numbers work, right? So we like to use these levels when looking at how much exposure, if any, we want to add to client portfolios. And the Russell 2000, so the Russell 2000, which gives you a better idea of what the average stock is doing, is back near its pre-COVID high. So the average stock, again, has not moved really anywhere in almost 2.5 years. There's been some ups, some big ups, but the last year and a half has just been absolutely draining. And then again, here in 2022 is where we really saw the breakdown. So we talked about the U.S., but what is going on the rest of the world? It is, if you can believe it, actually a lot uglier. And it has been. So international stocks have underperformed for the last 12, 13, 14 years, as U.S. stocks have done very well. So again, here's pre-COVID high for all stocks around the world minus those that are in the U.S. It's the best way to explain what this index is. So they crossed below their pre-COVID highs well back this spring and have continued to drift lower. In fact, they're back to where these lows in 2018. I know many of us remember Christmas Eve 2018 was not a very pleasant time of year. So we have now, through all these ups and downs, we have come back. Essentially no movement for the average foreign stock in 4 years. Emerging markets, even worse. So these are developed stocks. These are or from developed countries, your France's, your Japan's, your England's and Italy's. Emerging markets, this is more China, India, South Korea, Brazil, things like that. Even worse, now, almost looks like they could be targeting their COVID lows. There's really not much in the way there as far as support and resistance. So the trend says that this probably continues and we do get down here at some point late this year or maybe early 2023. And U.S. Treasuries. So this is going back to 2003. And as you can see, the last year and a half has just been awful for long-term U.S. Treasuries. Obviously, long-term getting hit the most because they have the most exposure to changes in interest rates. And now trading back to levels we saw in 2011. So you basically captured historically low interest for the risk you were taking over the last decade, right? We know that you weren't getting paid much to have your money sit there. Yeah, you probably did okay with your cash flows. but how much of that has now been wiped out? From a principal standpoint, almost a decade of invested capital. All right, so Dave also loves to talk about, and I agree with him, 3 main goals. If you've done client education with us, you know this is something we harp on quite a bit. Big wins, which is awesome. Everyone loves big wins. Small wins, not as awesome, but still good. And small losses. We absolutely want to avoid that 4th and missing piece, which is the big loss. So let's talk about some times this year that we hit the sell button. We can get on here and talk about great trades, and yeah, that's fun. But let's talk about times where we were willing to hit the sell button so that a loss did not become worse. Here's semiconductors. This was back earlier this year. Trend started, trend does not work out. A few days later, you take the loss of 7%, no one likes that. Has been down 81% since then. So we are very, very quick, especially in an environment like this. And in a healthy market, you can give things a little bit more time to work themselves out. But in a year like 2022, you absolutely want to be quick to pull the trigger if something is not working immediately. Global Foundries, this was a stock we purchased, actually one of the strongest stocks at the time. There weren't a lot of things going up this past March and April. This did not work out. And then again, for a few days, we take the loss. Yeah, it's a small position, but it's, 12%. It doesn't hurt, but it doesn't mean it's comfortable. Down 28% since then. 27%. Albemarle. Very strong stock this year. We were involved in it. I want to say a little bit before this, but I guess that's what Pretty put on the chart. Again, another one, 2 to 3 days, not working out. And it did bounce back a little bit, and you can say, well, Ian, why didn't you just wait to sell it up here in late September? Well, I didn't know that was going to happen, and I'm not going to take the risk to see if, to stay in that position for clients. American Express, another one. A small loss here in it for a few days. Has been down ever since. Enphase, this is actually one of our interns' ideas. Entry, very, very strong stock. Stayed up here and consolidated for a bit. Broke down. We've gotten rid of it, and then down another 16% since then. Natural gas, so getting into commodities. A 6% loss to avoid a 33% drawdown. Global shipping, a 1% loss to avoid a 29% drawdown. Technology, a small gain that just still was not behaving right. I didn't like the action. 52% since then. Carbon credits, one of Kevin's favorite areas. We'll be up here in a little bit. Very small loss. Very small minimal loss. Started off good. Nothing you can do about 2 straight gap downs. It hit our sell stop, 23 basis points, and here we are 3 months later, it's down another 25%. And again, 20-year treasuries, I know why Dave put this chart on here, because back here in 2020, he entered and exited this trade in, I think, an hour. Now, of course, no one was sitting there saying, his reasoning was not, I think bonds are going to go into a 2-year bear market. It's just that the price didn't work out. What unfolded happened to unfold. Obviously, they have been in a pretty rough shape since then. Now, that is not our typical MO. We are not looking to be in things for an hour. It's just the way this one happened to pan out. All right, so seasonality. We are going to talk about what stocks may or may not do depending on where we are in different cycles, election cycles, but also in the calendar year in general. So this is what the average midterm election year, going back to 1927, looks like for the S&P 500. If you took all the midterm election years, Doesn't matter who is president or what party was in charge. This is what it looks like. So, all in all things considered, I would say it's tracked this composite pretty well. Now, the composite says we should see a rally here into year end. Will that happen? I don't know. It hasn't started yet. That doesn't mean that it couldn't start right now as we're talking. I don't know. Maybe stocks are up 5%. So here is just another look at seasonality, and this is the average year. The average year for the S&P versus what a midterm election. So as you can see, a lot of antsiness going into October and November. Very different type of spring and summer months. You're actually averaging about a 6% drawdown here versus a 3% gain in any other type of normal calendar year.
What year is it?
What year? So this is all years. So this is all years averaged together for midterm election years. So like your 2022, 2018, 2014, 2010, and then this is all years, no matter where we were in the election cycle. So here, we're going to throw even more in. All right, we'll get into first year midterms, right, because this is Biden's first midterm. He is a Democrat. And a second year new Democratic president. So all of these pretty, and up here in black is, again, that same chart we had here in purple. It's just in black on this one. So here we are. The orange line is where you are at. So again, we see that volatility usually continues into late October. Then as investors become more comfortable or have more sight into who will be winning various political seats, things get a little bit more bullish. We will see if that pans out. I'll be honest with you, I'm not holding my breath. And the last slide here kind of also showing that the average bottom in midterm years does happen on October 9th. So we, again, are in that. Could happen a week before, it could happen a week after. On average, it's about this time of year. All right, so elections and the market. If you can, in fact, I think the last time we presented on this would have been Q4 2020. Dave and I are very political people. Not when it comes to positioning, but in our personal lives, we love to chit-chat about politics just as much as the rest of you. So we're going to talk about which party has an advantage when it comes to the stock market. So midterm elections, as you can see, 2022 right now, pretty dead split, 50 Republicans and 50 Democrats in the Senate. House of Representatives, 212 to 221. Here's just some data on leaning and seats that may or may not flip, what's more likely. But this is what I want to get to. All right, so which party is really the better one? And this hasn't been updated to show our current president. I should have put this on here, right? Should have shown how bad it's been. So which party is better? So go through all these, and don't worry, I did the math for you I think it's the next slide. And before I show you the next slide, don't look. I too wish I could sit up here and say that my political party of choice was better than the others. The truth is, it's not. No one is better. There is no data over all the years that we have had a president, which has been a long time in this country, that says one party is better than the other. It evens out. Again, I know it makes me feel some type of way when people get elected and I don't agree, and I've got it, worked up in my head that this is going to be horrible for the economy. That is not always true. Right? And I think we all saw that in 2017 with Trump. How many headlines were there about what he was going to do to the economy, take your money out of the market, this will be horrible. And I think it was actually pretty good there for, I think those 4 years were really good. So unfortunately, no matter which way you lean, you do not get to go and tell your friends, my party is better for the stock market and for our 401ks than your party. So with that being said, I'm now going to pass the remote on to Kevin. And he's going to talk to you again about the S&P 500. Go into a little bit more detail on that. Ian, you have a question? I have a question. Oh, yes, sir.
Would it be safe to say the average midterm election, then that the market average does rise a percentage or two? And if so, what would that percentage?
After the elections happens?
Yes.
Yeah, usually there tends to be a pretty strong year-end rally.
And what would that percentage be average?
Let's go back here to the chart. So you're averaging going down from, let's say, 6 to 2, 4 to 0, 2 to... So I would say 4 to 5% rally that you could expect in the final 2 months. But again, this hasn't been an overall very bullish year. So there's more of a chance that gets ignored and we just don't see a rally because investors don't really care who's president. They all just see it going to heck in a handbasket.
Round of applause for Kevin. He is our ace trader. Just passed his CMT exam, sent in the application. Hopefully by the next time he's presenting, he has the fun 3 letters right behind his name. Thanks, Kevin.
All right, thank you. So like Paul mentioned, personally it's been a pretty slow year. Not really much going on. We ended up buying our first house. I think we closed kind of end of May, beginning of June, which we were not planning on doing that. It was just an opportunity that came up and we kind of happened to capitalize on it, so that was cool. And then September 17th was our wedding day, which was nice. The weather held off, which is perfect. Thank you. And I still don't know why we did this, but for our honeymoon, if you want to call it that, we started tearing up our house. So that's been fun. And I was telling a few people this, especially with the remodel and kind of how we're going to put it back together. I'm starting to find out I don't really have as much negotiating power as I kind of did before. So it's funny how that works out, right? All right. So back to the market. What I'm going to talk about here is the 60-40 portfolio. First, what is that? It's pretty simple on the surface. It's a target allocation, 60% stocks, 40% bonds, right? It's probably, I would say, the most popular target allocation that there probably is now, and probably has been for a while. But if you've been paying attention to kind of the content we put out, or even really just the media at large now, there's been some issues with that for kind of a while here this year. You can kind of see from some of the headlines there, it's been the worst return in 100 years. It's a long time, right? People are starting to wonder, is the 60-40 dead? It's hard to say. We're kind of seeing some data out there now. You can see that chart on the right there is an annualized number, so they're projecting a little bit there, but they're kind of targeting a 3% drawdown in the 60-40 portfolio, which is kind of unheard of. Really the main idea, if you will, behind this allocation is when stocks that 60% aren't performing the best, the 40% should at least lessen the blow, right? Historically, stocks, bonds, it's kind of been accepted that they move opposite of each other, or at least not as close in line. But if you've ever
heard us say this before. Sometimes correlations can come to one, and now we're seeing them both move in the same direction. So what this shows on here is kind of individual parts of the 60/40. The legend up top, when I start going through these, will tell you exactly what they are. It just shows the tickers with the percentage in the bottom right. But essentially what you're seeing here, TLT and AGG are kind of broad bond proxies. So TLT would be long-term treasuries like we talked about here before. AGG is more of an aggregate index. It's a little more broad-based. So you can see the performance of that compared to the S&P, which would be that 60% that we talked about before. And then what AOR is, it's not exactly 60/40. It kind of flips between 50 and 7% long stocks, so it's close. But you can see this year, this is current as of yesterday, that's 20% lower year to date, and you can see that 40% there really hasn't done a very good job of lessening the blow on stocks. It's actually performed worse depending on how your bond portfolio looks. And that, I know we brought this up before, that image on the left we've had probably in the last couple presentations, but the drawdown bonds we're seeing now, we're kind of in uncharted territory. If you look at that image on the right, it's targeting its fourth worst year, and those years are a long time ago. The one that stands out to me, just because I've been listening to an audiobook on it, is the end of the Civil War. Is kind of one of the last periods that we've seen bonds, or like government treasuries, perform this badly, which obviously with what was going on in the world at that time, that's not hard to believe. So it just kind of puts things in context there. So just drawdowns in general in bonds. It's not just treasuries, even though we like to talk about that because they have been so bad. But what you'll see here, LQD and JNK, those are corporate bonds. So JNK or junk bonds are kind of more your risk on bonds. And then LQD would be what they call investment grade, so safer. Getting a little trigger happy here. This just kind of makes the point that it's not individual segments of the bond market, but it's essentially the bond market as a whole where we're seeing these drawdowns. And like Ian mentioned before, the longer you go out in the term, the worse it gets.
Kevin, we have a question over here.
Yes.
This I-bond, government I-bond,
Yep.
hearing about being 10%,
Mhm.
where does that fit in here?
So I don't have that on here, so it's funny you bring that up. I think we had that question.
Could you just repeat it? Sorry.
Yep. Oh, sorry. Yep. So the question was government I bonds. I think you said they're paying what, roughly 10% now? 9-10%. Yeah. It's been a minute since I've looked at what it is. So essentially, what those are government bonds where they're paying you a base rate, and then on top of that, they're essentially adding in the inflation rate. So with the inflation rate being what it is now, that's why it's paying 9-10%, which I don't know what the last inflation rate number is off the top of my head. But when we started getting a lot of questions on these and looked into them a little more, the trick with those is you really got to pay attention to the base rate. And this is off the top of my head, I can't remember exactly, but I think the base rate for those were less than 1%. So really, it looks attractive when you see the number, right? It's kind of shocking, 9-10%. But essentially, they're just compensating you for what you're losing against inflation, and you're still only netting that base rate of, could be 0.5%, 1%. So in theory, it would kind of help you hedge against inflation, but you're not exactly gaining what you think you would. But right, individual bonds like that kind of depends on term. If you hold them,
It doesn't go down like the market.
in theory, I mean, any bond traded over the open market in price is going to react to interest rates. So the way I like to think of it is interest rates rise, the bonds you currently hold, right, should have a lower interest rate than what's coming out in the open market now. So if I was to go to sell that to somebody else, they're not going to pay me face value. So if you're transacting in these bonds, that's kind of where you see the drawdowns, like here, because these aren't individual bonds per se. You're not buying one specific bond from Apple, right? It's aggregated or long-term treasuries that are showing current price effect. as long as there are no defaults, things like that, sure, you should at least get your interest rate, right? But there's an opportunity cost there too, I guess. That's also not taken into account. Yeah, bonds get kind of tricky. Does that kind of answer your question? I probably didn't do a very good job of it. I went all over the place. So Dave touched this, so we'll kind of skip on past that. But kind of what we mentioned before, we talked about the S&P 500 a lot. So kind of figured we should at least touch base, just kind of maybe more some interesting facts about it, maybe things you might not have known. So the members only private club here, right? So the S&P 500 isn't just exactly the largest cap 500 stocks in the U.S. market. There are kind of some membership requirements, if you will. So to be eligible for this, and this is kind of a very top-level view, obviously you have to be a U.S. company because it's a U.S. index. Your market cap has to be at least $14.6 billion. And they list this in there, which is funny. You have to be highly liquid, which obviously, what does that mean? What they mean by that, I'm not sure. They probably have some volume requirements there. Public float, which is a fancy way of saying at least 10% of the shares that are out in the market must be publicly held. So that's all that means there. And then they do actually have a positive earnings requirement, which is, I don't think many people know that. Essentially, the point here is it's just because you're one of the bigger, possibly the most popular stocks out there, it's not really a popularity contest. And if you actually read some of the S&P's material, they make that pretty clear. And what most people don't know is that just because it's an index, it's not very static. So what this chart does a good job of showing, which it's actually kind of hard to read this. So the dates at the top go backwards to how you normally read it. So 1990s on the right, and this goes over to 2001 on the left. So what this is tracking are the additions and subtractions each year within the S&P 500. I mean, at least I did before I really got in finance, assumed the S&P 500, the most popular, highly liquid 500 stocks in the market, wouldn't change that often, right? Well, that's not necessarily the case, especially because some of these eligibility requirements, and I know this does a good job of highlighting that in year two acquisitions, especially now you can see over time they've really grown. So we like to, I think Dave likes to say this sometimes too, the S&P 500, just with how well it does performance-wise, it's really the most successful hedge fund there is in the world. I mean, it's an active management index. I mean, they're changing constantly when they rebalance. Companies moving in, companies moving out. It's not as static as you would really think. So this is just kind of a fun trivia question. I found this out when I was looking at a blog post. So on the S&P 500's 50th birthday, which is, I think, 1957, it was in March, I think was when it was established. So in 2007, how many of the original companies or stocks do you think still remained in the index 50 years later? Any guesses? 10? You're on the right track, I'll tell you that. 30. A little more than that, 86. Which, I mean, it sounds like a lot, but when you think it started with, and I think it was a hair over 500, that's 83% of the original index for one reason or the other gone. So over 50 years, it's essentially a new index, right? Which you don't think about until you really kind of start digging into it. 711 companies kind of changed hands in there. It's a lot of turnover. So that came out to an average of 5.5% of the index a year. It's kind of crazy when you think about it. One thing, too, people don't necessarily know, it's not an equal weighted index. What that means is everything that's held within the S&P 500 is not equal. It's based on market cap. And I know we've showed this a lot here before, the one on the lower left. So the weight of the top 10 stocks, which just fluctuates with price a little bit, is 30% in here. And I think I looked yesterday, it was around 28%. So it's pretty close. So if you think about that, the entire index of over 500 stocks, almost 30% of that are in just 10 names. So really when you see that here, and it's not just individual names, it's all these different sectors, industries, things like that. None of them are equally weighted. So you can see on the right here, this is current Sector weightings, the one on the left was just going back historically, but that only goes up to 2021. But you can just kind of see there over time, there really are quite a few changes just in the makeup of this index, even over just a couple of years. Like information technology now, which is 26% of the index, in 1996 was 12, so it over doubled. So just one thing to keep in mind, which I'll kind of show you here, when we see some of these S&P performance figures, Apple's the largest weighted stock, I think it's close to 10 or 7%. Year to date, it's only down 0.5%, while the S&P is down 15. If you think you get more of those top 10 stocks that start to roll over, that's when that number really starts to grow. So it's just when you start looking at some of these individual names, sometimes the few can hide the pain until you start kind of looking at them individually. So even just outside the S&P, Dave mentioned this before, energy is something we've really been paying attention to. This is year to date. Really, energy's been the lone survivor. And you can kind of see that in different types of energy too. It's kind of not necessarily equal there as well. But these are all of the other kind of main sectors that most people track are all negative year to date, and energy's kind of still hanging in there strong. Drawdowns, just some more info. The bond market's not the only place you're seeing drawdowns, right? And outside of the S&P and the major indices too, when you start to get into like ARC, which is pretty popular now, pretty tech focused, that's down almost 63%. This one at the bottom, there's SPACs. We've talked about those before, special acquisition companies. It's a whole nother story, but those aren't doing very well either with IPOs. Kind of some of your more speculative names there. So just kind of interesting to see really the magnitude of some of these drawdowns. Individual names too, you can kind of take a look at some of these if you recognize any of the names, but I mean, look at some of these, almost 100%. That's what we like to call headline risk when you have some of these individual names. Same here, cryptocurrencies. Really, the whole point is that there hasn't really been anywhere to hide other than energy, and like Dave mentioned before, treasury bills, which are 1 to 3 months. They've been stable. Really, everywhere's been affected so far. And with that, hopefully I'm still doing all right on time. We'll have our Q&A.
Yep.
One question.
Mm-hmm.
Going back to where you had the chart, the S&P 500 active management, and you had mergers, acquisitions, etc.
Yep.
For 02, you had a number of 23. But when you look at the numbers, there's only 5. And all the other numbers correspond 30, 58, 42.
Right.
How did you get, was that the number there, or?
Yeah, I think so. And that's the thing that. Oh, go ahead. Yeah, so what Mr. Carley there pointed out is this last thing here for 2002. This isn't my own data. I took this from an outside source. Doesn't really add up there. And the whole point of this was it was supposed to stop at 2001. So actually, I'm not sure myself where they're getting that. But really, the whole point of this is just to show essentially magnitude on how many changes per year. Yeah, that's a good catch.
All right. Thank you, Kevin. Let's get to the panel, and let's actually take a look at what the results were from the poll, if you would, Dave. Let's take a peek.
Oh no! Oh, mystery.
Went off the screen.
Mystery.
It's going so well.
Looks even.
Higher or lower?
Kevin's looking. Okay, here we go. So in 6 months, will the market be higher or lower from here? 46% say higher, 54% say lower. So pretty even. I think some of the chatter I heard in the background is something along the lines of it depends on the election. But Ian beat you to it. Said it doesn't matter. All right, next question.
Yep. What is the safest asset class from those listed below? Stocks, bonds, or commodities?
Wow. I did not expect this. No. Okay, so what is the safest asset class of those listed below? 15% said stocks, 29% said bonds, and 56% said commodities. Not what I would have guessed. So there's some licensing tests that we take, and they tell us it's bonds. Now, we all just went through why bonds, when they're laddered and put in aggregate, can be troublesome. They're not risk-free either. Does gold serve as a good hedge against inflation?
So 65% yes.
65% say yes, and 35% say no. Yes. So this is a little bit of a trick question by teacher, because what currency is it priced in? Because if it's priced in dollars, it's done a terrible job. If it's priced in yen, it's done an amazing job. So if you live in Japan and you own gold, the yen has been getting crushed, you're doing okay. And this is why, as an adaptive team, these guys are searching out all these different things in these relationships. Now, we don't currently, the size of our firm, have the ability to open an account in yen over in Japan and buy gold. Lord willing, someday, 5 to 10 years from now, maybe we can do stuff like that. But right now, we have to operate in dollars. Gold's been terrible. I wish that we had that chart up, but gold's breaking below 1,700 an ounce, and that's been a big level. And so that, I don't know the correction number percentage-wise, but it has not done well in an inflationary environment. So we've got 2 minutes. How do you want to do this?
All right, there is a question I want to address, because when you show the charts and everything's been going down, I think Ian did a nice job of, hey, this is when we entered, when we exit. But even with some of the downturns, there's up days, right? So what if we miss the best days of the market? What happens then?
Yeah, so this is a preloaded question, because this is something I've been hearing in the media lately. Like, hey, you can't time the market, because if you're out of the market, you're going to miss the best days. And that's a little bit of, that's garbage science. That's dumpster diving. And like, you're grabbing the good fruit out of the dumpster and ignoring everything else that happened around it. When we look at this data, if you could forward it, let's go a couple slides ahead just to skip ahead. Basically, you can't just identify best days and say, oh, if you miss those, you're in trouble. You need to look at everything together. You can't just look at it in a vacuum. And the way to simply put it, it's like best days and worst days are boyfriend, girlfriend. Like, they're always hanging out together. When we look at bad markets, that's where the best days happen, are in bad markets. 2008, 2009. The red dot represents where the 25 best days have happened. So during, a 56% correction, you had over 10 best days in the last 25 years. Same thing with the dot-com bust, same thing during the COVID crash. We even saw a best day, what was it, last Thursday? That was one of the best days in the market. That could, that is a hallmark of a bear market. Mm-hmm. So missing the best days is okay, because they're right next to the worst days.
Right. All right, I'm going to do one more question, because I know we're coming up right on 1 o'clock. And if you do have other questions, maybe we'll have them email your team, the Adaptiv team email, and then you can add it to some commentary that comes out later. That's all right. So you covered a lot of weakness over multiple asset classes, right? All the charts just look outstanding. Tongue in cheek. What are some things we need to see to have a bull market return? What would we like to have happen?
I assume you mean a bull market in stocks?
Yes.
Okay. So obviously we want to see, for stocks to stop going down, we'd want to see them start going up. But other assets we can look at to see, is there any type of risk taking in the market that could spill over to stocks? So junk bonds, no. No one has any interest in taking risk in the fixed income space. Cryptocurrencies, no. I could argue that crypto is on the verge of going through another 30 to 40% decline here soon if it doesn't turn things around. So those would be other places other than the levels we showed, like the S&P above 4180, things like that. there's other assets we were looking at, there's very little in regards to any clues that we're close to a bottom here.
Sorry if I add.
Yeah.
So one of the reasons why we threw this chart here is this identifies stages of expansion and contraction. And I think it's one slide ahead, Kevin. So bonds turn down first, then stocks turn down, then commodities turn down. So if you look back at that other chart, what stage are we in? Not a trick question. Provided the answer. Stage 6. Stocks down, bonds down, commodities down. So to Ian's point, to see a return to risk-on behavior, stocks have to stop going down. But just as importantly, bonds have to start going up at some point. And they just haven't. And that would be the end of contraction. Would start to see bonds lead, and then stocks join, and then commodities join. That would be the most likely sequence on how we see this.
So we're going to conclude the Q&A. Like I said, if there's other questions, just email. We're going to have to wrap it up here. We're right at 1:03. If I can get to that, you have a feedback form. You can fill that out, or if you want to use the QR code on there, please do so. We'd love to hear on 1, the content, 2, how it helped you, 3, if you need some help, there's areas to let us know that. And then we have our team back there where you checked in. Just hand those forms in. That'd be helpful.
I'm wondering if you would give me permission to go through this real quick.
Yeah.
So, because
we're calling it audible.
Yes. Well, and the reason why I want to do this is any good presentation, you end with the thing you want your audience to remember. So that's what we're doing. So you can have amnesia about everything else, but any good asset manager has a game plan. They don't have a prediction. Do you know how many investment banks had a prediction of something like 4,900 on the S&P for the end of the year? Might still happen. I have no idea. But we don't operate in predictions because predictions make us feel good. It's a false truth. It's a Roman Coke. Having a plan is what should make us feel good. So if we go to the next slide, quite simply, 3667 in the S&P 500 is the June low. If we're above that, risk taking is possible. Above 3915, we're going to be aggressive. Below 3667, we want nothing to do with it. Okay? Next slide. This is the 200-week moving average in blue. What you'll notice, and I could have gone back all the way back to the 50s, when you get below the blue line, that's when things get really hairy, really fast. Okay? As long as we're above the blue line, it's not hairy, it's not fast. It could just be slow and sideways. We'd like it to stay above the 200-week moving average. What's our plan? Our clients know that we're holding a ton of cash and T-bills. Why? Next slide. This is also, we talked about a bunch of Debbie Downer stuff today. You know what the great news is? We're finally seeing higher interest rates for retirees. That should be a round of applause. Okay? Because this T-bills basically move flat. They don't have a lot of volatility. They're 1 to 3 months. And they're paying between 2 and 4%. So we own a lot of that in our clients' accounts right now while we're waiting for risk on. This is not a situation that we had on our hands before. And now we do. And so sometimes we'll get questions from clients like, hey, we're holding a lot of cash. You think I should go buy some CDs? No, because I can get almost 4% in a T-bill, be liquid, and when the market starts to turn, we can get out of that and into the market. So that's our game plan. Above 3667 in the S&P, we'll be involved. Below it, we want nothing to do with it. In the meantime, we'll own T-bills. As always, 3 main objectives: big wins, small losses, avoiding the big losses, and managing risk for our clients. Thank you for your time.
All right, so hand in your forms. Thank you for coming. Next month, we're going to have the True Holistic Financial Planning team with Justin, Brad, and Jake hunting for bucks. So thank you all for coming and enjoy the rest of your afternoon.